This is Bite-Sized Business, the channel where we take company news and reports and simplify it down into a few important metrics and ratios to determine a company's financial health. In this installment, we will take a dive into McDonald's. The starters. McDonald's is a multinational fast food chain based in Chicago, Illinois, founded in San Bernardino, California in 1940. McDonald's has over 40,000 restaurants in 120 different countries and territories and serves over 70 million customers a day. The staples of McDonald's include the Big Mac, the McChicken, the chicken nuggets, fries, and their special blend of Coca-Cola. The main course. A disclaimer before we proceed. McDonald's as a corporate entity does not sell hamburgers as a primary source of income. McDonald's is a real estate company who makes money on a corporate level through franchise fees, rent, and other sources of income derived from franchisees. In the last 12 months, McDonald's has done $26 billion in revenue. This is up from 2 years prior where they did $23 billion in revenue. In the same time period, net income increased from $6.2 billion to $8.2 billion. Now off to the balance sheet. McDonald's has $56 billion in assets, which is up from $54 billion 2 years prior. However, they have $61 billion in liabilities, which is up from $58.5 billion from 2 years prior. This leads to a shareholder equity of negative $4.7 billion. Off to the cash flow, we see that McDonald's reported a free cash flow of $6.6 billion in the last 12 months, which is up from $5.5 billion 2 years prior. This has helped McDonald's consistently buy back over $3 billion of stock over the last 3 years, or about $10 billion in total. This is a graph of McDonald's outstanding shares. As you can see on this blue chart right here, this is the total amount of shares that they have, and this starts in 2009, where they had 1.1 billion. This is at the end of the most recent quarter, or at the end of September 2024, where McDonald's had 720 million shares. That's a pretty sizable drop of about 400 million shares. This graph right here, with the red and green bars, shows the percentage of change in year-over-year quarterly growth. The red number is actually good because that means they have bought back more stock. Specifically, we want to look at this section right here from 2022 to 2024, where year over year the shares have been decreasing by about 1%. In total, over this time span, they have bought back a little over 5% of the shares outstanding. Off to the dessert in the Excel sheet. This gives the overview of everything we previously talked about. The company name that we went into today was McDonald's. They trade under the ticker symbol MCD. They're in the fast food industry, even though they primarily operate in real estate and franchise fees. In the last 12 months, they have done $26 billion in revenue. They have done $14 billion in EBITDA, $8.2 billion in net income. The company holds on to $53 billion in total debt, $56 billion of assets, and nearly $61 billion in liabilities. The assets and liabilities leave us with a number of $4.7 billion in negative shareholder equity. In the last 12 months, McDonald's has done $6.5 billion of free cash flow. Now off to the ratios based on these numbers. McDonald's has a debt to equity of negative 11.28. This is because McDonald's has a substantial debt load at over $50 billion, and they have a negative shareholder equity. The debt to EBITDA ratio is 3.83. As we spoke about in the previous installment, debt to EBITDA takes the company's debt load versus EBITDA, which is a metric used to gauge earnings of a company before interest, tax, depreciation, and amortization. A lot of people believe this is the true way to determine the profitability of a business. The EBITDA margin is 53%, meaning that for every $100 of revenue McDonald's does, they expect to have $53 of EBITDA, and the net profit margin of 32%, which would say that for every $100 of revenue McDonald's does, they expect to profit $32. Now off to the comparisons. So, the debt to equity is negative, and that is not a good thing. A negative debt to equity means that there is really no value left for shareholders, but I will get into why why that is going on in a little bit. They have a high debt to EBITDA range because it is outside of that 2 to 3 times range that we would prefer to see. But these numbers do come with some sugarcoating, as the EBITDA margin is extremely high, being 52% or 53%, and that is well outside of the 20% margin that we expect to see out of the high range. They have a net profit margin that was 32%, which is much higher again than the 10% or higher we were expecting to see on our high range. Now, I will get into the shareholder equity. So addressing the shareholder equity, McDonald's is a company with negative shareholder equity. This means that they have more liabilities than the combined value of company assets. For McDonald's, this stems from having high debt at low interest rates. The average rate is approximately 3%, and I got that from basing their total debt of around $50 billion to their interest income that they report on their income statement, which was about $1.5 billion. The reason that they have so much debt is that McDonald's has spent a large share of its cash flow buying back stock instead of paying off debt. And that is shown from that graph where in 2009 they had 1.1 billion shares, and as of September 2024 they had 720 million shares. Based on these numbers, I don't think it's justified to give McDonald's a green light on financial health, and while I don't believe the company is going anywhere anytime soon, the high debt load and negative shareholder equity means that they are only really one slowdown in the fast food industry away from possibly having a big issue. And based on some of the other things McDonald's has done in their corporate history with failed acquisitions, it would not surprise me if McDonald's does get themselves into a rut. But because they have such a high EBITDA and such a high profit margin, I cannot justify giving them a red light because they are still in relatively good financial health. Due to this, I'm going to give them more of an orange light or a yellow light because they are in good financial standing as they are able to pay off their debt and still return capital to shareholders. But if their growth slows down or they experience negative growth in a year, McDonald's could be in for some issues. Every good meal has a check, and the check is just the drawbacks or the downside to each meal. In this case, McDonald's being the meal and some of the bad news about the company being the check. As previously mentioned, the negative shareholder equity is a bad thing, and that is part of the check, but we're going to go over some of the recent news that McDonald's just had. McDonald's just had a recent listeria outbreak that reportedly killed one person and sent 34 more to the hospital. This will likely lead to some lawsuits, including a wrongful death lawsuit towards McDonald's, assuming that McDonald's is found to be the sole contributor to the listeria outbreak. And this could have an issue for the share price and investors. A lawsuit is never a good thing for a company because it means that the company is likely going to spend money on legal fees trying to get out of it, and if they can't get out of it, they're going to have to spend a lot more money to whoever is suing them. In this case, a wrongful death lawsuit can be pretty expensive, and so this will likely have an impact on McDonald's. While this likely won't kill McDonald's because they're so large, it is still something to take into consideration due to their poor financial health. Thank you for watching this Bite into McDonald's. If you have any tips for future videos or company suggestions, let me know in the comments below. In my next video, I will be doing Wendy's, a competitor in the space, to see if they are in better or worse shape than McDonald's. Wendy's is significantly smaller than McDonald's, trading at a market cap of $3.7 billion compared to McDonald's $211 billion. Even though they are of two completely different scales, it will still be interesting to compare two large companies in the space.